Hello everyone, today we are going to explain chapter 23, which is chapter number 5 in our syllabus, and it is talking about flexible budget and standard cost system. Actually, chapter has multiple learning objectives. The first one is to prepare the flexible budget and performance report using static and flexible budget. First of all, we have to know what do you mean by budget and how do managers use budget to control the business activity. Managers use budget for planning and controlling business activity. Actually, budgeting means we are expecting, forecasting specific numbers based on information that we have from the history of the company, and then we are going to take a decision in the future based on the result of this budget. We have the master budget, and actually this is what we covered in managerial accounting, and it was focusing on the planning step. And the controlling step focuses on decision making made during and after the budgeting period based on the actual result, which means planning, I'm doing the forecasting, I'm doing the expected numbers, and then I'm going to take a decision. And the end of the period, I have to evaluate, did I comply with this budget well or not? And if there is any variance, positive or negative, it must be analyzed in order to find out how to avoid that deviation in the near future. So actually here we are focusing on the controlling step rather than the planning step, because the planning step, as I said before, we covered in the managerial accounting course. As you can see here, this is the budgeting objective. The budgeting objective is to have a control. As we said, we will start by the plan and then we act according to that plan. We are getting control, comparing the actual with the budgeted, and then a feedback to identify the corrective action. What are we going to do in order to deal with the deviations or the variances between the budget and the actual, and then we will go to prepare the budget for the next year, and it is a continuous process to be done always by management. Performance report using static budget. The master budget is a static budget, which means it is prepared for only one level of sale volume. Static means we are stuck with one number. I will expect that the sales next year will be 100,000 units. So I will prepare the budget based on that 100,000 units. So actually this is a static budget, which means we are not preparing a budget for different group or different levels of expected sales. This is why we call it a static budget. And the variance here is the difference between the actual amount at the end of the period and the budgeted amount that we prepared at the beginning of the period. The static budget variance is the difference between actual result and the expected result in the static budget. But actually here I'm only preparing one level of sales expectation rather than doing more than one level of. As you can see here, the variance may be favorable or unfavorable. Favorable if the actual amount increase the operating income. For example, I budgeted $100 revenue, but the actual came 110. So actually the actual revenue is more than the budgeted revenue, and this is a good thing that happened. So actually this is favorable. On the other hand, if the actual expenses was less than the budgeted expense, I expected that the expense will be 50 and actually I only incurred 40. So here this also will result in increase in operating income. The result of the variance will be favorable if the actual minus the budgeted result will increase the operating income, and it is unfavorable if the actual amount decrease the operating income. Here the actual revenue is less than the budgeted revenue. I expected 100, but actually what I achieved was 80. Actual expenses is higher than the budgeted expense. I expected 50, but actually I achieved 60. So the result here will decrease the operating income. result here income. Actually, this is one form of the flexible budget using the static budget variance. Actually, as you can see here, I'm saying that the static budget is 50,000 units or batches, and here actual result is 52,000. So we have a favorable variance 2,000. Why it is favorable? Because we expected 50 and we achieved 52. So there is 2,000 that increased in the actual operation, which means it yielded more operating income. So it is favorable. So the sales revenue, whenever you multiply this number of units by the selling price, you are expecting, of course, that the sales here will be higher than the static. So actually the difference will be favorable, as well as the units we are discussed previously. The variable cost, I will say that I have direct material, direct labor, variable overhead, and as you can see here, this is the budgeted and this is the actual. Here the actual is higher than, and this would decrease the operating income. So actually this will be considered as unfavorable. The direct labor is less than the budgeted, so this is favorable. The variable overhead is less than, so this is favorable. The same to be applied for selling and administrative, for example, and this is the total variable cost. Then I will subtract the total variable cost out of the sales revenue, and that will result in the contribution margin. And then I will subtract the fixed cost, manufacturing, the same will be done. I have 23, I was expecting 25, so this is favorable. Selling and administrative 25, and this 22, so unfavorable. Total fixed cost and operating income, as you can see. So actually, in the actual case, we achieved operating income that is higher than the expected. So we have 2,570 favorable variance. The difference between the actual and the budget is to be called variance. Actual minus static equal to the budget. Flexible budget. What we talked about was the static budget, making a flexible budget using static numbers. Okay, the flexible budget summarizes the revenue expenses with various levels. This is why we said that the previous slide we used only one level of sales, the budget that we prepared at the beginning. This is why we said it is a static budget. Here we are doing that for different levels of sales. So actually this is to be called flexible budget. Flexible budget separate variable from fixed, as we did, yes, and the variable cost put the flex in the flexible budget, and this we will understand it in a minute, explaining the numerical example. Preparing the flexible budget. A flexible budget need budgeting selling price per unit. We need to, of course, make a budget for the selling price, the variable cost per unit, product cost, manufacturing cost, and variable selling and administrative expenses, total fixed cost, and the different volume level within the relevant range, which means we have to have more than one level of sales in order to call it flexible. Right, as you can see here, actually the table here is showing a flexible budget. This is budgeted amount per unit, and those are the different types of different levels of sales. We made a budget for 48,000 level of sales, 50,000 level of sales, and 52,000 level of sales. And of course, because the selling price per unit is the same, whenever I will multiply it by the number of units, I will get different numbers. And then I will subtract the cost, as we did in the last one, blah, 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 okay? And then we reach it for the total variable cost. I will subtract the variable from the total sales. So actually I have a contribution minus fixed cost, and this is operating income according to each level of sales. operating income for each level of sales. Okay, very good. Here, and I didn't do a variance analysis. I only prepared the budget for different levels of units. So actually, in order to use that in an effective way, we have to prepare a budget variance. And the manager wants to know why a variance occurred, because flexible budget variance is the difference between actual result and expected result in the flexible budget for actual units sold. Again, in the static, we compared between the actual and the only budgeted level that we did. In the flexible, we will do the same, except for that we are going to prepare the budget using the actual number of units have been achieved. Yani, for example, I made 3 levels of budget, as you can see, but actually the actual units that have been sold during the year was different than those 3 budgets. So I'm going to prepare the budget as if we expected the actual number of units. And this will result in a variance between actual result and expected in the flexible for actual unit sold. And then we prepare what we call sales volume variance, and this is the difference between expected result in the flexible for the actual units sold and the static budget. The difference between expected result in the flexible budget for actual units and the static budget. Yani, I'm going to compare between the level of expectation in the static budget and the flexible using the actual unit, as we are going to Actually, this is summarizing what we would like to do. The shape is showing that we have actual result, as we said, and we have flexible budget and the static budget. As you can see, the actual result is, if I consider this as a column, so this is column number 1, column number 2, and column number 3. So actual result, of course, actual units multiplied by actual prices and cost. In the flexible, based on the actual number, actually I'm going to get the actual number of units multiplied by the budgeted selling price or cost. At the static, based on expected number, I'm going to have budgeted multiplied by budgeted costs and prices. يبقى actually this is the budget variances. Actual compared to flexible compared to static budget. The difference between actual and static, it is a static budget variance. The difference between actual results and the flexible budget, this is flexible budget variance. And the static and the flexible, this is the sales volume variance. This means that the static budget variance is equal to flexible budget variance plus sales volume variance. And this is what we just said in the previous. This is an illustration to what we just explained. For example, here I have the actual result, as you can see. I have the flexible. This is the actual. This is the flexible. And this is the static. Okay, and the variance is the difference between each two. If you can see, this is actual, as we said. We don't care about it now because actually we did it before. And we have the flexible budget. Also, we prepared it before. And the static, this is the first that have been provided by us at the beginning of the chapter, as you can see here. Okay, actually, I will start by the first one. I have sales revenue. Sales revenue is 384,800, and let me use another color like that. This is okay. The sales, which is 384,800 and 390,000. The difference is that the actual in revenue is less than the flexible budget. So actually this will be considered as unfavorable because you expected something and less happened already in during the year. Okay, and the cost 104,000 and this is 91. I expected 91 but actually I achieved 104, so this is unfavorable. Direct labor 145,000 and it is 156,000. Okay, so actually again this is favorable because actually here the cost is less than what expected, and we will continue up till the end. And the difference between the actual, which is 36, and 37, this is to be called flexible budget variance. Flexible budget variance. Okay, very good. On the other hand بقى, flexible and static. I have here 390,000. Okay, and if you can see, just one remark. We said this is actual, right? Actual units by actual prices and cost. Here we use the 52,000, which is the actual units multiplied by the budgeted selling price and costs. Type in the static, actually we didn't use the actual units, we use the budgeted units multiplied by the budgeted cost and prices. So actually if I'm looking here, I will consider as if the flexible budget now is the actual. This is why when I said we in the flexible budget we have 390,000 compared to the static, I will consider it favorable because I'm considering here the flexible as if it is the actual one when I compare it with the static. So whenever it will increase, the difference will increase the operating income, I will consider it favorable. طيب here 91,000 direct material. On the other hand, we have 87,000, which means we expected 87, but we achieved 91. So this is unfavorable because this is cost. And the same will be done for everything until we reach for the operating income. We have 37,000 and 33,750. So actually this is favorable. Okay, because the income here, the operating income here is higher. And this is will be called sales volume variance. Sales volume variance. Sales volume variance. The addition of both flexible budget and sales volume is the static budget variance. Is the static budget variance. And when we add them up, we have 680 unfavorable and we have 3,250 favorable. So actually as if it is minus and plus. يعني as if it is 3,250 minus 680 and it resulted in 2,570. This will lead us to the second learning objective of the chapter, which is to identify the benefits of the standard cost system and understand how that. Why do managers use a standard cost? What we did now is to be called the standard cost because it is budgeted. And we use it in order to control the business activities. Most companies use standards to develop budget. Yes, we use standard expectations in order to develop or to prepare the budget. A standard is a price or cost or quantity that is expected under normal condition. Under normal condition. So the standard cost system is an accounting that uses standards for product cost. Standards means expectations, budgeted. And if you look here, the direct material, for example, this is the cost standard and this is the efficiency standard. We are looking here that responsibility, like مثلا the purchasing manager. What are the factors affecting the cost standard of the purchasing manager? Purchase cost, discounts received, delivery requirements, credit policies. Type. What are the efficiency standards? Responsibility, like the production manager and engineer. Product specifications, spoilage, production. This is efficiency. We are looking here for the cost standards. The same in the direct labor. We have human resource manager, wage rate on experience required, payroll taxes, fringe benefits, efficiency standards, like the production manager. We have time requirements. Okay, we have production levels and for production levels and employee experience needed. يبقى actually this is the efficiency standards for that person, which is the production manager and engineer in the direct material or in relation to direct material and direct labor, and this is the cost standard for the human resource manager related to direct material and direct labor. The manufacturing overhead بقى nature and amount of resources needed to support activities such as moving material, maintaining equipment, and product inspection. And this is the overhead cost that we talked about before, that including all the indirect costs of the production. How to calculate the standard cost? We are saying that, for example, direct material cost standard for paraffin equal to purchase price net of discount 1.65, delivery, receiving, and inspection 0.10, so the total standard cost per pound is 1.75. Direct labor, the hourly wage, the payroll taxes, and the total standard. So actually this is the per unit for the direct labor. We are following the same classification we did in the previous slide. The variable overhead, actually we are going to estimate the variable overhead and divide it by the estimated quantity of allocation base. And actually this is what did we study in chapter 2, if you remember. Chapter 2, okay? Flexible overhead cost equal to estimated fixed cost over the estimated quantity of allocation base. This is the rule that we talked about when we talked about the allocation of overhead. Okay, we are getting totals over the estimated totals over estimated cost driver or allocation base. The efficiency standards. Production manager and engineer set direct material and direct labor efficiency standard. Labor standards are established from analyzing the production process, and the efficiency standards are based on best practices called benchmarking. Actually, this is to be used as a tool for evaluating the performance and setting the cost standard process. The standard cost system benefit. Standard costing help manager to prepare master budget, and master budget, as we said, is 1 year budget to be prepared according to one level, which means it is a static budget. Set target levels of performance for flexible budget. Help me also in preparing the flexible budget, because in flexible budget we are preparing the budget based on more than one level of sales, expected sales. So actually one of them mostly will be the statistic budget. Identify the performance standards that we are going to evaluate the performance based on. Set sales prices of product and services, and to decrease the accounting cost by making the variance less every year. As you can see here, this is the cost and efficiency variance. We have the actual cost, as we said before, multiplied by actual quantity. This is the actual, as we said. Then here we are getting the standard cost multiplied by actual quantity. This is the flexible. And then we have the static, which is standard and standard. Standard and standard. And the standard quantity allowed means we are going to calculate it based on the actual numbers. Okay. Type. This will result in a cost variance. This will be result in the efficiency variance. And both will be considered the total product cost variance. يعني the difference between the actual and flexible, it is a cost variance, as we said before, which is the flexible budget variance. And the difference between the flexible and the static, it is the efficiency variance, and this is what we call the sales volume variance. And both are total product cost, which is the static variance that we talked about. The cost variance in terms of equation, يعني we can do that in terms of equation. You can do it like we said before in the figure or in the format that we just explained in the previous slide. You can draw it and do it like 3 columns, and the difference between the 3 columns will be the variance, or you can do it right away using equation. Type cost variance measure how well the business keep unit cost of material and labor input within standard. The cost variance is the difference in cost as input multiplied by actual output used of the input. As you can see here, this is actual multiplied by actual. This is the actual. Minus standard cost في actual. This is flexible. We can manipulate it to say that actual cost minus standard cost multiplied by actual quantity, as taking actual quantity as a common factor. So the rule for the cost variance or the flexible budget variance is actual cost minus standard cost multiplied actual quantity. Okay, type efficiency variance, the other part of the figure that measure how well the business use its material or human resources. It is the difference between the quantity multiplied by standard cost per unit of the input. Here this is standard multiplied by actual, which is flexible, minus standard cost multiplied by standard quantity. This is the static budget, and we can manipulate it again in order to say that actual quantity, here the standard cost is the common factor. So the actual quantity minus the standard quantity multiply the standard cost. Okay, very good. And here we are talking, of course, about the input. Efficiency is talking about input. Right, so the variance relations again. The actual cost, the difference are static. This part is flexible. The flexible is divided into cost variance and efficiency variance. And this is the sales volume variance. Okay, again, the flexible budget here we divide into cost variance and efficiency variance. The cost variance, okay, is related to the cost of the inputs, and the efficiency variance is related to the efficiency in using the input of the production. Learning objective number 3 is to compute the standard cost variance for direct material labor. The same will be done, except that we are going to talk here or concentrate on the direct material and the direct labor. This is the budget amount per unit. This is the actual result, flexible, and the flexible budget as we did before. So actually I just got the differences here, as you can see, in order to find out the flexible budget. Okay, very good. The direct material cost was 9,750. Let's apply the standard or the equation that we learned from the previous learning objective. The direct material cost standard is the direct material efficiency standard, the actual amount purchased and used, and the actual cost of the input. Actually, the direct material will be actual quantity minus standard quantity. Actual cost minus standard cost multiplied by the actual quantity. The standard cost is 1.6. The actual cost is 1.6. From where did I get it? Actually, he is saying that we have actual amount 65,000. And it costed me 104. I will divide the 104 over the 65 to get the 1.6. Minus the expected, the standard 1.75. Multiplied by the actual quantity, which is 65,000. So it is 9,750 favorable. Why favorable? Because the actual cost is less than the expected cost. The direct material efficiency variance. We said that the direct material efficiency variance is 22,750 unfavorable. The variance in unfavorably code worker used more paraffin than they planned for 52,000 batches of crimes. Direct material efficiency, we said that actual quantity minus standard quantity multiplied by standard cost. The actual quantity of input 65,000, we just said that in the last slide. 52,000, okay, actually it was there, and multiplied by the standard cost, which is 1.75. So actually it is 22,750 unfavorable. Why unfavorable? Because the actual is higher than the standard. This slide is actually giving me a summary of the direct material variance. As you can see here, actual cost multiplied by actual quantities, finding me this is the actual that we paid. Actually, this is the standard cost multiplied actual quantity. It is, as you can see, this is standard quantity cost multiplied by standard quantity, and the difference here is a cost variance. There is a efficiency variance, and both are the total direct material variance. The direct labor will be treated the same. We are going to calculate two variances: the direct labor cost variance, actual cost minus standard cost. Actual cost is 145,600 over the actual number of hours, it is $14, and minus the standard rate, which is direct labor cost standard 12, multiplied by the actual direct labor hours, which is given as you can see here, and the variance is unfavorable because actually the rate per hour, actual rate per hour is higher than the standard or the expected rate per hour. It will be done for the efficiency by doing or multiplying the actual quantity of hours minus the standard quantity multiplied the standard cost, and it is here favorable because the hours here is less than the expected one. Again, this is the summary for the direct labor variance: actual cost multiplied actual quantity, standard cost multiplied actual quantity, standard cost multiplied standard quantity, and this is the cost variance, efficiency variance, and the total labor variance. Actually, this was the first part of the variance analysis, and the second part, inshallah, will be coming shortly to be covered together. Thank you.